are you guys? Hope you all are doing really great. Let's start with the next chapter in the super revision series of accounts. The chapter is Reconstitution of a partnership firm in case of retirement or death of a partner. Before starting the class, let's just remind ourselves of the 3 points that we are agreeing upon. One is this is the revision class and not a substitute for your full syllabus, and the assumption is that you have at least done the chapter once before watching this revision video. The second one is you have your notebook and a pen with you to scribble down along with me. And the third one, you're sitting and watching this lecture and you're not in your bed and listening to it as your bedtime story. So as usual, I have the basic structure of the mind map, which you can pause the video and write it down. The chapter is divided into 5 parts. Hope you all have written this now. Now starting with the first point, concept of retirement or death, reconstitution in case of retirement of death. So whenever a partner retires or dies, the old partnership deed that was existing between all the partners comes to an end. And there's a new deed that is formed and the business continues with remaining partners. Now, if we have to write the points under this, the key points will be the first one, existing deed ends. New deed is formed. Is framed. You can say it like that. And then the last one is the business continues. Okay. Now this was very simple and quick. Now coming on to the profit sharing ratios. What are the ratios that we calculate? Can you guess? The first one is obviously quite obvious. New profit sharing ratio, because one of the partner will not be there. So now we have to calculate new profit sharing ratio for the remaining partners. So how will we calculate this? So this is basically how the remaining partners will share the future profits. Right. How will we calculate this? The formula for this will be whole share plus acquired share. So the retiring partner's share is taken over by the remaining partners, and the future profits will be shared in this new ratio that we will calculate as per this formula. The next ratio that we'll calculate is the gaining ratio. This is nothing but your acquired share, right? So this shows who gains how much due to retirement or death of one or more of the partners. So we can write it as who gains how much. Who gains how much is with respect to the remaining partners. And the gaining ratio is equal to new share minus old share. Okay. Next, why is this gaining ratio used? The gaining ratio is used for goodwill adjustment. If you remember in the previous chapter, we were using the sacrifice ratio for goodwill adjustment, and here it will be used for, here the gaining ratio will be used for goodwill adjustment. Then calculation of hidden goodwill. We know the concept of hidden goodwill already. And then the last one is to divide the profit up to the date of retirement. Cool? Cool. So these are the two ratios that we'll calculate. Moving on to the next one, that is your accounting adjustments. So this is the core important part of this chapter. We can call it the heart of the chapter. We'll make a heart over here. So let's draw a heart. A beautiful heart, because this is the heart of the chapter, really important. This is where all your questions mainly come from. So first is your goodwill. Ma'am, again goodwill. It was so big, huge discussion in the previous chapter. Yes, again goodwill. But this time it is pretty simpler. If you have done the earlier chapter well, if you have done the admission part well, it will be easier for you. So, right? So, goodwill represents the reputation of the firm, value of the reputation. Right? I don't have to write this again. We have just revised this in the earlier video. So, at the time of retirement or death, the goodwill is valued on that date, on the date of retirement or death. And the retiring partner gets his share of goodwill. So, he takes away his share of goodwill. It is paid by the gaining partners. That means the remaining partners. So, goodwill is valued on date of retirement or death. And the second point is retiring, or we'll just call it outgoing partner. We can't say dying partner, right? So, outgoing partner gets his share of goodwill. Okay, are we cool with this? Moving ahead, and it is paid by gaining partners. That means your remaining partners. So here we'll have two situations for goodwill treatment. One is goodwill is already in the books. The other point is goodwill is not in the books. Yeah. Now, when goodwill is there in the books, it is written off. That means all the partners are given off their share. The capital account is credited. In case there is no goodwill given in the books, so there is no existing goodwill in the books, so it will be adjusted through capital accounts. So here, but obvious the entry will be partners capital debit, partners capital account debit to goodwill account. In what ratio? An old ratio. Okay. It's quite logical. All the partners are still there in the business, they will be given their share. And what about goodwill not in the books? So, when goodwill is not there in the books, the remaining partners shall bear this. How will they bear this? The remaining partners capital account debit to outgoing partner. A capital account. This will be in old ratio, full value. Okay. In this case, it will be in gaining ratio in only value of outgoing partner's share. Is it clear? So this will be in old ratio. This will be in gaining ratio. Okay, very good. And then there's a point of hidden goodwill here. In under the goodwill point only, there's a concept of hidden goodwill. So when will we understand that there is hidden goodwill? So hidden goodwill is understood if a partner is paid more than his capital balance. So the excess is equal to the hidden goodwill. So this comes out to be the balancing figure between the payment and the capital balance, right? So this is the first adjustment that we have covered under accounting adjustments. And then the second one. This is easier. This is revaluation. Revaluation of what? Assets and liabilities. Always remember only assets and liabilities, that is your balance sheet values, can be revalued. Your P&L values will never be revalued. So what is the purpose of revaluation? Anyone? We have done it in the last class. So it is to bring the assets and liabilities to current values. Remember guys, I'm writing everything with you so that you write along. Right? You have to write more than me. Try to write more than me because board exams are yours, not mine. I have already cleared my board exams. Right? What are the steps of revaluation? Does anybody know the steps of revaluation? If you know, very good. If you don't know, hope you have done this chapter at least once and during the year, because remember, this is a revision of the chapter, not the complete explanation of the chapter. So the step 1 is revaluation account is prepared. The revaluation rules. So the revaluation rules refer the earlier video. Okay. In that earlier video, I have explained how what will be debited, what will be credited in case of revaluation. When the assets value increase, revaluation account is credited. When the asset value decreases, revaluation account is debited. When liabilities value increase, revaluation account is debited, and when the liabilities value decrease, revaluation account is credited. Okay, you can refer to the earlier video to have this clear. I have given you a table as well, so refer to the earlier video for that table. Then coming to the second step, profit or loss is calculated and transferred to all partners, including the outgoing partner. Okay. And the ratio that will be used will be old ratio. Always remember, whenever you are giving it to all the existing partners, including the outgoing partner, it will be in old ratio. Okay, clear? Remember once again, whenever you're uh, dividing anything, transferring anything to all the partners, including the retiring or the outgoing partner, it will be always in the old profit sharing ratio. Good. The next accounting adjustment is accumulated profits or losses. So, what are the accumulated profits or losses? What are the examples for this? Examples are general reserve and P&L balance. Deferred expenses also come here. And the treatment is this is distributed among all partners in full ratio, right? For the journal entries of these, all these journal entries are covered in the earlier chapter as well. I'm not purposefully revising it here because you have already either watched that chapter or you will go and watch it later. To keep this video concise, I'm not doing it again and again. I'm not repeating the things that are repetitive in nature. The entries, of course, you're expected to know the entries already, but in case you don't know the entries, you can refer to the earlier video. That would be better so that, of course, even I advise you to do admission of a partner first and then come to retirement and death of a partner, because more than half of the concepts are covered in that chapter. All the journal entries are covered in that chapter. So, in that, we have actually written all the entries that will be passed, right? Go refer to that video as well. Okay, easy. These are the three accounting adjustments that we'll do. One is goodwill, second one is revaluation of assets and liabilities, and third one is accumulated profits or losses. Moving ahead, amount due to outgoing partner. What does that mean? That means what is the amount that you have to pay to the outgoing partner. So what is the amount that you will pay? Obviously, the amount that is there as left as the capital balance of the capital account will be paid to the outgoing partner. Right? So what will we do? First thing is credits. We'll add all the credits. So that is add all the credits. And what are the examples of credits that you might have? One is obviously the capital account balance as on the date, the initial opening capital account balance. And then if you have a current account, that means you're maintaining a fixed capital method of capital accounts, then you'll have current account balance. And then the share of goodwill. Then what? Share of revaluation profit. And then share of reserves. Then interest on capital. And what else? Salary or commission. Where are these coming from? These come from your chapter 1. Yeah, admission of a partner is chapter 2. Then you have interim profits. Interim profits is you calculate the profits till the date of retirement or death. Okay, interim profits. Are we clear with these? These are the credits that you might generally see, not all of them, maybe some of them. And then there are debits. Just a second, I'll just adjust the space for you. Hope you all are writing it smaller so that you don't have this problem. The second one is debits. So what do you have to do? You have to subtract these amounts. What are the examples of debits that you will have? One is drawings. Then interest on drawings. Then share of revaluation loss. The last one is share of accumulated losses. Okay. Yes. Now, when you add all the credit amounts and then deduct the debit amounts, you will get a value. The net result, I'll write it down here for you. The result, net result means you are adding all the credits and subtracting all the debits. The net result will amount to your amount due to the outgoing partner. Now you have found out what is the amount that has to be paid. Now, what are the methods in which this amount is paid? It's called your settlement methods. So, in once the amount is calculated, it is settled in the following ways. I'm writing each and every word that I'm saying so that you write along with me, you maintain pace with me. This is for your benefit. I'm repeating it again and again. This is for your benefit and not my benefit. Your board exams, right? So please be serious and write it along with me. The first is lump sum payment. What does it mean by lump sum payment? Being commerce students, being 12th class commerce students, I assume you know this. Lump sum payment is you're paying the whole amount together in a single shot payment, in a single payment. Then the second one is if it's not paid in a single payment, what can it be done? It can be paid in installments, right? Installment payments. Then the third one is it can be transferred. So basically, remember it like you're paying it in single shot. You don't have money, like the whole money to pay it in single shot. So you're paying it in installments. So when you're paying it in installments, it will be paid along with interest. Okay. Okay. See, you don't have money to pay installments also. You're very poor. Then what will we do? We'll transfer it to loan account. So we'll treat it as a loan from the outgoing partner to the firm. Right. Account. Then this is in case of retiring partners. What about In case of death. So in case of death, obviously your partner is not there. He's dead. So he cannot come and take money from you. He cannot receive money from you. What will we do? In case of death, it is transferred to the executor's account. Executor's account. So, do we need journal entries for these? I don't think so. But still, chalo, let's do the journal entries as well. For lump sum payment, it is easy. What will happen? Outgoing partner capital account debit to, oh sorry, you will have, if you have current account as well, you will have outgoing partner current account debit as well to bank account. Okay, we cool with this? Then you have this outgoing partner capital account debit, outgoing partner current account debit to what? Tell me, what will come? It is treated as loan. Loan account of outgoing partner. Ma'am, this is the third type of treatment. Yes, this is third type of treatment. So while you're paying in installments also, it is considered as if it is transferred to loan account, and as and when the installments are paid, the payment entry will be made. So this is the same entry that will be given in the third case as well. Okay. And on payment, loan account of outgoing partner to bank account. Whenever this is outgoing partner, loan account of outgoing partner debits to bank account credit. So always remember whenever there is a payment that is happening, you have to involve bank or cash, and that will be by crediting bank or cash when there is a payment that you are making a payment, and when you're receiving a payment, bank bank or cash is debited. So until the full loan is paid, it appears as a liability in the balance sheet. And in case of death of a partner, the outgoing partner account debit, outgoing partner capital account debit, outgoing partner current account debit to executor loan. This is also considered as loan. Loan from executor account. Clear? These are the journal entries. For the other journal entries that are involved in counting adjustments, please go through the earlier video of admission of a partner. Here we complete a comprehensive concept revision of reconstitution of a partnership firm in case of retirement or death of a partner. So with this, we come to an end with reconstitution of a partnership firm. There's another chapter left in partnership accounting for dissolution of a partnership firm that will be covered in the next video. So I'm ending this revision here. Until we meet in the next video, prepare well, stay healthy, stay safe, eat healthy food, drink lots and lots of water, and keep revising smartly. Bye bye.